welcome to Livewire Markets. I'm Ali Selby, and this is your ultimate guide to picking ETFs for income. Today, I'm joined by Michael Wayne from Medallion Financial. Thank you so much for joining me, Michael.
Thanks for having me as always, Ali.
What are some of the questions that your clients usually ask you about income? Could you share some of their pain points with us?
Yeah, absolutely. I think many investment advisors, many financial planners would get this question a lot these days. Is how do I get enough income out of my investments in the stock market, whether it be direct shares or ETFs, without eroding that capital base? Because when you look at the ASX these days, the average income across the board is probably about 3%, 3.2% yield. So compare that to a couple of years ago when it was 4.5%, 5%. It's becoming more and more difficult to extract that income to live off day to day. So that is definitely a pain point for a lot of customers. Another one as well is whereabouts in the markets do you get income from? Because many of the traditional yield sectors, such as the banking shares, even things like Telstra, they've seen their dividends come down over the last 5-10 years, quite a long way. And we're seeing many of the sectors that you wouldn't typically associate with income being the ones that are paying out high dividend yields. So you're looking at things like materials these days, things like Fortescue Metals, BHP. For us, we tend to avoid being drawn into those sectors because we think that they're very cyclical, very volatile. So that is our typical viewpoint. But we do hear many customers that we speak to asking, should we be moving into some of those other sectors that produce the high income, at least in the short term, because we're missing out on our more traditional sectors. But I think investors need to be very careful because the share prices of those companies can very quickly turn to the downside, eroding any oversized income that you might be getting, as we've seen in recent weeks.
Do you think that ETFs can provide an attractive solution for income investors?
Yeah, absolutely. People often associate ETFs with the equity markets, but these days there's a lot of ETFs out there that give investors access to the corporate bond markets, to the hybrid market. So if you think about the hybrid ETF managed by Coolabah Capital, that's a typical ETF that we use, which helps produce income for clients. Then there are different sort of corporate bond ETFs, high yield ETFs, things like IHCB, for instance, IHHY. These types of ETFs are able to boost up the income component of a client's portfolio, and used in combination with their equity investments can give them not only access to growth through the equity exposure, but then through some of these fixed income ETFs gives them a nice steady income stream as well throughout the course of a 12-month period.
Michael, I'd love to know, what is more important in your mind, management fees or performance?
Look, ultimately, performance is everything. But for the more passive ETFs, the ones that are simply mirroring an index or simply mirroring a sector or an underlying commodity, they have to be low cost. There's no point just getting broad-based passive exposure and paying high fees. However, if you're looking at some of the more active ETFs or some of the ETFs that give you exposure to niche parts of the market or exposure to products that retail investors usually couldn't get access to, then we're happy to pay higher costs and then higher fees if it means that we're getting that exposure, which can boost up returns, but also boost up diversification and also increase access to different parts of the market. So I think it just really depends on the type of ETF. But in the end of the day, we're trying to get good results. And if we can increase the returns and increase the results by paying a bit more, then we're willing to do that.
Is there a holy grail income ETF in your mind that satisfies on both fronts?
Look, I think it depends. There's probably one it's an Australian listed ETF, but it gives you exposure to the US markets, and the code is UMAX. So basically, this gives you exposure to the S&P 500, but they implement a call strategy and they write a number of calls, which helps reduce the volatility, but can also increase the yield of that particular investment. So that has returned over the last 12 months, something like 25-30% capital growth, but has also delivered 5 to 7% yield distribution over the last couple of years consistently. So that is probably an ETF that jumps to mind that we use that covers both the income, but also the growth aspect to a client's portfolio.
I'd love to know how you incorporate active and passive ETFs in a client's portfolio, particularly for those nearing retirement.
So when it comes to the Australian equity market, we typically help clients invest directly. So we would invest in the shares themselves when it came to the Australian market. But then, for instance, when it came to investing in the US markets or gaining some international geographical exposure, we would then use passive investments because we can't add much value with our smaller team to cover that enormous universe. So we focus on direct shares, being active in what we're good at, and then we use passive investments to gain that geographical exposure. We also use active ETFs when it comes to things like sector exposures. So if you think about the AC/DC ETF, which gives you exposure to lithium and the electric vehicle and battery space, that is typically an active ETF that we use to get a broad exposure to an emerging sector. So that probably sums up how we can use both passive and active ETFs in unison, again, within client portfolios.
Michael, in your view, is an active approach the way to go when investing in ETFs for income, or should investors stick to passive?
I think it makes sense to be passive when looking for a passive income stream. That way you can determine within your own mind what it is you're looking to achieve out of your investments, what income do I need to live off for the next 6 to 12 months, and then picking an investment portfolio that is able to deliver that steady stream of income for you. Many of these different corporate bond ETFs, for instance, only pay it out quarterly, pay out distributions quarterly, others pay out monthly. So you're going to have to keep that in mind. And it makes sense that you're going to hold many of these investments for the medium to longer term, rather than jumping in and out of different ETFs. From time to time, there'll be tactical decisions that you make. There might be a certain policy decision made overseas or a change in central bank attitudes, which might mean you want to reduce your exposure to, say, high PE, high growth type ETFs and focus more on some value cyclical type ETFs. But that is sort of probably changing things around the edges at the margin, if you like, as opposed to making wholesale shifts in strategy just to get different amounts of income.
Are there any new entrants to the ETF income market that have sparked your interest lately?
Yeah, so basically there's a new ETF that's come out from Coolabah Capital. The code is FIXD, so fixed income hedge fund essentially. So it's a long short fund that takes positions either long or short in the fixed income markets across a number of different spheres in that fixed income space. Coolabah Capital have shown themselves to be very good managers over a long period of time. And I think this new particular ETF, given that is a long short fund, really is agnostic when it comes to market moves one way or the other. And again, that's a unique form of investment that retail investors wouldn't normally get access to. So for them, that is a way to gain diversification and exposure to the fixed income space, which they probably don't already have within their portfolios. So if that one is one that we have been buying for our fixed income focused clients. In this market, we'll probably be steering clear of something like the Asia Tech Tigers ETF. Again, that's a thematic that is coming under a bit of pressure at the moment, given what's going on in China and the technology industry over there. So that's an ETF on the flip side that we would be avoiding at the moment. So yeah.
I was just about to ask, are there any other thematics that you believe have run their course that you think investors should steer clear of other than Asia Tech Tigers?
I think investors need to be conscious of inflation rearing its head and some of the shift in the dynamics of the driving markets at the moment, and really have been, particularly at the beginning of 2021. We've seen obviously a shift away from many of the high growth tech names into the more cyclical value names. Whether or not that thematic will continue to play out remains to be seen, but I do think that the probability of inflation rearing its head, although it might not be very, very high, it's certainly increased, and it makes sense to have more exposure to, say, cyclicals than it does to, say, your high growth names. So again, at the margins, if you've been doing very well over the long term in some of those tech ETFs, you might want to reduce your weighting slightly. You still want to have probably overweight exposure to tech, given that the growth is probably very, very strong. But from our standpoint, you might want to sort of rebalance things slightly, take a little bit out of some of those tech-focused ETFs, and maybe look for some more cyclical value type ETFs out there just to rebalance your portfolio slightly.
Okay, Michael, last question. We asked you to bring along a model portfolio of income ETFs that you think can provide a sustainable level of yield in the current low interest rate environment. What are some of the ETFs you've brought for us today?
So some of them I've touched upon already. So the hybrid ETF will give you a good exposure to Australian hybrids, primarily bank hybrids. That's been a good performer over the years, low downside capture, consistent yield. There's also the IHCB, which is a global corporate bond ETF. Then there's the IHHY, which is the high yield corporate bond ETF globally. Then there's one called CRED, which is an Australian corporate bond fund. As I mentioned, we also tend to include some LITs from time to time to get exposure to interesting parts of the market. So for instance, the Griffith Income Fund, that's an Australian mortgage-based fund, which invests in mortgage-backed securities, and that's delivered consistent yield. So the way that we tend to look at it is you want exposure to Australian corporate bonds, you want exposure to international corporate bonds, you want exposure to hybrids, you want exposure to say the housing market. So within the different subsectors of fixed income or corporate bonds, there are different areas that you want to be exposed to. So that's the way that we tend to look at that.
There was no, I guess, equities exposure there. Would you still be allocating towards equities for income in this current environment?
One of the ones that we do have is that UMAX. That does give you exposure to, again, the S&P 500, and it's proven to have given you very good yield over the long run, as well as a good capital growth to the upside that the S&P delivers. Within Australia, the problem is when you're looking to generate yield in the equities, we tend to look at stock-specific investments, businesses that have a steady distribution over the last number of years, those companies that are able to potentially grow their income over time. So there's stock-specific calls that we tend to make, and then we use some of these ETFs in the corporate bond space just to give the portfolio a consistent income stream. But if I think about some ETFs in Australia that are income focused, there's the Harvester ETF. That's delivered some very good income, but the capital growth hasn't been all too good for that particular company. There's a Russell Investments high yield Australian ETF, which has done pretty well, delivered some very good income and as well as some good growth. But you have to understand in Australia that the market is really driven by your banks and your miners. So in the years like last year, when those parts of the market do very, very well, your ETF, your high yield ETFs are going to do very well, and not only in terms of capital growth, but income. But then when you go through periods where those particular sectors don't do so well, then your income might be okay, but your overall performance on those income ETFs won't be so good. So for that reason, we tend to focus on stock-specific companies that have the chance not only to deliver consistent income, but growing income over time.
What are the stocks that come to mind that you think, can deliver sustainable income over the year to come?
Yeah, so things like Sydney Airports was something that we were buying last year on the big pullback. Over time, once international travel does kick in, you'd expect those dividends or those distributions to kick back in. Things that we've been buying recently is Vicinity Shopping Centres, VCX. Basically, they own Chadstone Shopping Centre down in Victoria. They own the QVB here in Sydney. They own the Strand Arcade, DFO outlets around the place. So this is a company where if you're buying it now at today's prices, the distribution is around 5.5%, 6%. However, if income can return between where it is now and where it was pre-COVID, then there's a good chance that based on today's prices, your distribution will be close to 7, 8, 9, even 10% if they can get income growing back to where it was over time. So that's an investment that we've been purchasing recently for people if they want to go away and have a look at that.
Awesome. Well, thank you so much, Michael. It's been such a pleasure to talk to you today. Thank you again.
Not a problem, Ali. Thanks very much for having me.